Hello, I'm Ward Brown, and welcome to the New Year's edition of Argent's Market Insights videos. With each new turn in the calendar comes the annual ritual of market predictions. But Warren Buffett once said, any forecast of the future says more about the forecaster than it does about the future. So rather than try our luck with my crystal ball here, we're going to take a slightly different tack and discuss some things we'd like to see happen and not happen as the year progresses. If we could lay out the framework for a good year, what would that look like? Let's take a look. 2020 was a heck of a year in more ways than one, and 2021 is kicked off with a strong start. Number one on our wish list is the earnings growth needed to support the current high valuations. The market is expensive relative to history and has priced in quite a bit of the recovery. The best way to alleviate that is for companies to continue to earn more than expected. While we are confident that will happen, there remains a heightened level of corporate uncertainty. Number two, if we are going to get that earnings recovery, then we'd like to see the economic backdrop continue recovering as well. What do we mean by that? One helpful variable would be the passing of additional fiscal stimulus, the stuff Congress does, to bridge the gap between now and the hoped-for reopening of business, the hiring and corporate investing, plus the resumption of travel and other consumer behaviors that will contribute to more organic growth going forward. Breadth in investing is reference to the number of stocks advancing, going up, or declining at any given time. That's the focus of wish list item number 3. When the stock market is marching higher, as it has been, it is important for breadth to be strong. Lots of stocks going up, and not just a few of the biggest ones. There's a lot of conversation about how big the largest companies have become, especially in the technology sector. For example, Apple's market cap, the value of all of its shares of stock, is now worth around $2 trillion, when a few years ago, no company had a value of even $1 trillion. These companies like Apple are enormous, but they are also great businesses whose earnings have been extraordinary. Nonetheless, as this chart shows, they have grown into a massive percentage of the overall market. Lately, and positively, small and mid-sized companies have been leading the charge, with many of them residing in more value-oriented sectors such as materials and financials. It'd be good to see all these other types of companies continue to play catch-up and narrow the gap to their larger cohorts. Finally, number 4, interest rates. Interest rates have been creeping up a bit, and that's okay, as right now it's a decent indicator speaking to higher economic growth expectations. The 10-year interest rate is currently back over 1% for the first time in a while, but that is still historically very low by any measure. If the Federal Reserve maintains their current programs, and by every indication they will continue doing so for the foreseeable future, then we could have slightly higher interest rates. Slightly higher rates would indicate decent economic growth, be beneficial to banks, and keep the yield curve where it should be. All good indicators. In closing, with or without the crystal ball, we know there are always bumps in the road, but there is cause for optimism, and the pieces are in place for a good year. Thanks very much for watching.